Hi, llewellyn-davies, author, speaker, founder of Business Growth International and Strategy on a Page, and the strategy man. That's what I do. I do strategy, and we're going to talk about raising capital as part of that strategy today. Now, in the last blog, we talked about the different elements of raising capital. What are you raising the money for, and what are the sources out there, because there's a lot of them. Let's talk about bank financing at the moment. This is a hot one at the moment, I think, and I want to dispel a few myths. I'm actually going to sit on the side of the banks today. That's controversial for a start, okay? So, bank financing is very important to established businesses. So here's the myth, okay? If you are a startup business with no track record, or you're in ideas concepts, or you're in ideas generation thing, and you're going to the bank to raise some money for an idea, probably a tough gig unless you've got some security, some backing, you're able to asset back this or basically guarantee this against something. You have a tough gig. Why? Because banks are lending. But they're lending to solid businesses with clear strategy. Now, that's a good thing, because it's your money. Think about this. Your money, your savings accounts and your personal accounts is put into the banking system. The banking system then lends this money out to things. One of those is businesses. So here's the thing. Would you want your bank to lend your money to a really risky startup which has got no track record, no clear financials moving forward, or not? So banks are there. By the way, banks never should have been lending. It was never the point. Just we were a bit wild in the last 10 years. This is where we had the banking collapse. That's not happening anymore. Neither should it. Banks are lending. Now I've raised 1.5 million this year already, and it's February, in bank finance alone, right? Because it's out there and it's working, but it's working for businesses that have clear strategy. They're clear on their past, if they have one. Most of them do for bank financing. They're clear on their story and what's happened. They're clear on where they're going. They have clear profit and loss, balance sheet and cash flow. And typically the cash flow, i.e. the spare cash within the business, can fund a loan moving forward. If you don't understand some of those terms, then we're going to take it apart in a much deeper finance course. But understand that bit, which is you're currently making profits, okay? You've got a good solid model and you want cash to grow. You want to fuel that growth further. Your cash flow, i.e. how much profits on the bottom line every month moving forward, needs to be able to sustain the debt that you're asking for over a period of time, and some. There's some multipliers around that. It gets complicated as you get bigger. If your business doesn't show that, i.e. I'd like this money and I have no idea how I'm going to pay it back, Mr. Bank Manager, guess what? You're probably not going to get a loan, and neither should you, because that's a different game. If you're in a highly risky or uncertain or high-tech or that kind of world, it's a different thing. It's angel money, it's venture capital money, it's a different space. The banks are there to lend to solid businesses with clear P&Ls, balance sheets and cash flows, and with an ability to be able to repay. If that's you, great. Bank financing is available. It's very exciting times. I've seen some amazing banks on the scene recently. And by the way, the money I've raised across multiple banks. So the banks are back out there. They are lending money, but they're lending money to good, strong businesses. And so they should. It's your money, okay? So that's bank financing. So in the next blog, we're going to cover angel financing, which is slightly different. So come back and I'll talk to you then.